All right. We're picking up on chapter 7. We're looking at some ratios that we're going to look at when we're looking at receivables. So, chapter's been on receivables. So, the first one is receivables turnover ratio. It is net sales divided by average accounts receivables. What is average accounts receivables? It's the beginning AR plus the ending AR divided by 2. Okay. So it tells us how long does it take us to collect all of our receivables. Okay. So I believe they go through a problem here. We're going to take the receivables turnover ratio, take 360 days and divide it by the one we just found right there. And that tells us how many days we hold our accounts receivables. It will make a little bit more sense with numbers. Okay. So let's look here. This is Gen Digital. Let's look at Gen Digital. Okay. So right here, receivables turnover, they took the 33, 33, 38 divided by the 2-year averages. They did that for us, 144. So that tells us throughout the year, we're going to completely collect all of our receivables 23 times. That's a really high number. Okay. Then, if we take the 365 divided by the 2318, it shows that our receivables on average are only outstanding around 16 days. That is awesome. That would be really good, especially if you had a 30-day credit period, okay? And most of them are paying within 16 days. That looks really good. You're not just earning income and earning revenue, but you're collecting it quite fast. Okay. So let's look at this other one. And the first one shows us that we're only collecting it 10.45 times a year. That doesn't, if you think about there's 12 months in a year, I always kind of think about if there's 12 months in a year multiplied times yeah, let's just forget that. Well, 12 months, that's where I was going with that. So looks like around every 11 months, we're only collecting 12 a year stuff in about 11 months. Okay, so that's kind of what that means, but this is the real number. So it tells us on average, our receivables are staying with us. We're not collecting them for like 35 days, every 35 days. Um, it depends on what a company's credit period is. Okay. So if this company has a credit period, let's just say of 45 days, they're doing really good. Okay. They're underneath the 45. Okay. If they are a 30-day, I would be like, we might be extending credit to people who aren't paying us very quickly. Still not the worst, but man, they're not we're not collecting most of the time within the credit period. It's a little bit more than the credit period. Okay. So you have to look at that. You can't just look at this and say, oh, this one's better than this one. You can't really do that because the credit period for this one could be longer. Okay. So you kind of have to look at what the credit period is that they're extending credit. Okay. All right. A bank reconciliation. Yay. Okay. That is actually in the appendix. So I am not going to cover that. You should know how to do bank reconciliation from Principles of Accounting. I'll talk about it real quick. The main thing you need to remember when you are adjusting for a bank reconciliation, you have two sides. You have the bank and you have the book. We are the book. This is us. Okay. You figure out who knows this piece of information, and then you're going to adjust the opposite side. So if the bank knows a piece of information, that means we don't know about it. We're going to adjust over here on the book side. If it's something we know about, like an outstanding check, it's already in our book balance. We're going to adjust the bank side. Okay. And they have to equal. Bank and the book side, they both have to equal. If they don't, you did something wrong, go back and do it again. Okay. All right. I think, and here I'll just kind of hover over that a little bit if you wanted to pause the video and look at that bank reconciliation. Okay. Notice it's balanced. Okay. Oh, one other thing. realize that all of these things that's on the bank side, we already knew about. We knew that we took the deposit to the bank. We knew that we wrote the check. So no journal entries are ever made with these things. Okay. The things down here on the book side, that's the things the bank knew about, we didn't know about. We'll make journal entries for these items, but we don't make journal entries for the things on the bank side because we already know them. They're already calculated in our book balance. Okay. So there was a bank collection. If cash is going up, remember you're going to debit cash. If cash is going down, you're going to credit cash. Okay. So there's the journal entries for all of those. And we will stop there. And we are done with chapter 7.